Hi, my name is Brian. Welcome to this journey through space. Today we are going to study the chapter, which is General Insurance Fundamentals. In this chapter, we'll explore what general insurance is, how it functions in society, its economic importance, and various types of policies available. We'll also understand how general insurance differs from life insurance, the core principles that govern it, and its role in promoting economic stability. By the end, you will see how something as everyday as motor or property insurance is actually part of a much bigger economic system. Course overview. General insurance covers all types of insurance except life insurance. It protects against losses or damages to assets, liabilities, and other specified risks. Policies are typically short-term, often for 1 year, and follow the indemnity principle, meaning they compensate only for actual losses, not profit. The course will help you understand risk transfer, insurance market structures, and the economic reasoning behind them. We'll use case studies and examples to connect theory to real-world applications. Core characteristics. General insurance is built on 4 main principles. Risk transfer shifts risk from the policyholder to the insurer in exchange for a premium. Indemnity ensures payouts match the real loss, avoiding overcompensation. Insurable interest means you must have a financial stake in what's insured. Utmost good faith requires honesty and full disclosure from both sides. These principles keep the market fair, sustainable, and legally enforceable. Economic principles behind general insurance works because of risk pooling, combining many similar risks so the uncertainty is reduced. The law of large numbers ensures predictions about losses become more accurate as the number of policies grows. Premiums are calculated through probability analysis, considering expected claims, expenses, and profit margins. For economists, this is a fascinating example of risk distribution and market efficiency. Motor insurance overview. Motor insurance is one of the most common types of general insurance. It provides coverage against vehicle damage and liability for injury or damage to others. In many countries, third-party coverage is legally required. This ensures that the costs of accidents are spread across drivers rather than falling solely on victims. From an economic view, it reduces the social cost of accidents. Types of motor insurance. There are 3 main categories: third-party liability, basic coverage; third-party, fire and theft, adds theft and fire protection; and comprehensive cover, covers damage to your own vehicle too. The more comprehensive the coverage, the higher the premium. This tiered system allows people to choose based on their needs and risk tolerance. Economically, it balances accessibility with adequate protection. Property and fire insurance. Originally focused on fire damage, property insurance now covers multiple perils like storms or theft. It usually includes building coverage, contents coverage, additional living expenses, and liability protection. Economically, it supports property investment, mortgage lending, and recovery after disasters. Without it, property markets would be riskier and less stable. Marine and cargo insurance. Marine insurance, one of the oldest forms, protects ships, cargo, and freight earnings. Special features like valued policies, all risks coverage, and the general average principle make it unique. This insurance is critical for global trade because it minimizes the risks of long-distance shipping. Without it, international commerce would be far more uncertain and costly. Travel insurance. Travel insurance covers risks during trips, such as medical emergencies, trip cancellations, or lost baggage. It's calculated based on trip cost, duration, destination, and traveler's age. Beyond individual benefits, it stabilizes the tourism industry by reducing financial losses from unforeseen events. Economically, this protection encourages people to travel more confidently, supporting jobs and GDP. Agricultural insurance. This protects farmers from weather, pest, and market risks. Types include crop, livestock, and revenue insurance. Challenges include systemic risk, like drought affecting many farmers at once, and moral hazard, less incentive to prevent losses. Governments often subsidize premiums because agriculture is vital for food security and rural livelihoods. Commercial risk coverage. Businesses use insurance to protect assets, cover business interruptions, and manage liability. Specialized coverage includes cyber risks and environmental liability. This reduces volatility, encourages entrepreneurship, and safeguards stakeholders. It's a foundation for modern business risk management. Policy renewal and endorsements. General insurance is usually renewed yearly, with possible adjustments in coverage or premiums. Endorsements allow for specific changes without rewriting the policy. These mechanisms keep policies flexible and relevant to changing needs. Insurance market structure. The market involves policyholders, insurers, reinsurers, brokers, and even capital markets. Risk moves through multiple layers to prevent any single entity from bearing excessive losses. This interconnected system supports global economic resilience. Key takeaways. General insurance is essential for protecting against a wide range of risks. It operates on clear principles, supports economic stability, and facilitates commerce. Understanding it from both practical and economic angles gives you insight into how societies manage uncertainty.